Hello guys, welcome back to PrizeDr's YouTube channel. This video is in the hashtag investment for dummies playlist, and today I'm going to talk about bonds, from what they are and how you can use them in your portfolio today to lower your risk. A bond is basically an instrument that represents a loan made by an investor to a borrower, typically by the government. A bond could be thought of as a sort of I.O.U. between the lender and the borrower that's under a contract and includes the details of its loan and its payments. Bonds are used by companies, states and governments to finance projects and operations that they might be doing. Owners of bonds are either debt holders, creditors, or the issuer who made the bonds in the first place. Bond details include the end date when the principal or the total value of the loan is due to be paid to the bond owner, and usually includes the terms for variable or fixed interest payments made by the borrower. Now, that sounds fairly confusing, but a bond is basically a company or government borrowing money from you and paying you back in interest and then eventually the principal. You usually get periodic interest payments, and at maturity you get the amount that you put in at the beginning back, and you'll always know how much interest you're going to receive over the bond term. Governments all around the world and corporations commonly use bonds in order to borrow money for quite cheap. Governments need to fund roads, schools, dams or other infrastructure projects that they want to do, so they end up having to borrow money temporarily between 1 to 10 years that they wouldn't otherwise be able to get so cheaply in order to fund these. When governments or firms need to raise money to finance new projects or maintain ongoing operations or refinance existing debts, they may issue bonds directly to the investors. The borrower, or the issuer, which is the government in this case, issues a bond that includes the terms of the loan, interest payments that will be made, and the time at which the loaned funds, or the bond principal, must be paid back. So that's called the maturity date. The interest payment is also called the coupon, is part of the return that bondholders earn for loaning their funds to the issuer. The interest rate that determines the payment is called the coupon rate. Now for the advantages and disadvantages of bonds. You can receive steady passive income by holding bonds and can get your principal back at the maturity date, and you stand to profit if you can sell the bond for a higher price than you purchased it for. The disadvantages include the fact that bonds give lower returns and interest rates than standard stocks like the S&P 500, and the company you got the bond from can default on your loan if they run out of money, and bond yields could fall, leading to losing money in the long term. An example of an investor that uses bonds in their portfolio is Ray Dalio, an American billionaire and hedge fund manager and co-chief investment officer at Bridgewater Associates, the largest hedge fund in the world, since 1985. This portfolio thus deserves some praise and is made for the purpose of performing well no matter what the market conditions are. Because of this idea, the portfolio consists of roughly 55% US bonds, 30% US stocks, and 15% hard assets, such as gold and commodities. Historically, since February 2006, the so-called all-weather portfolio made by Ray Dalio has compounded at a rate of 8% a year, which is higher than the S&P 500, but less than the traditional 60-40 US stock bond portfolio which most people have, and has significantly less sharp dips and rises. You can see this from the graph how it fared during major market swings. Remember, this is not financial advice, this is financial edutainment, so only follow this after you feel comfortable doing so. That's it for this video, hope you enjoyed. Let us know what you want to see on Investing for Dummies next. Be sure to give our site a visit when you can to earn some free, easy gift cards in exchange for a bit of your time. Thanks for watching, and until next time, it's been PrizeDr, signing out.